legacy of the last 2 years is going to be de-globalization. The kind of secular environment for inflation and interest rates is beginning to change. We're just in a different world now. And this is a very different kind of dynamic that investors are going to have to get used to. And that's the kind of essence of the macro supercycle.
So I want to kick things off, just to set the scene. You did a great interview with Alfonso Peccatiello and Andreas on the Macro Trading Floor, which is another Blockworks show, about 3 months ago. So I want to get your thoughts on how your thinking might have evolved since you've given that interview. But I want to start actually with this great blog post that you wrote back in July, which is the nightmare scenario for central bankers in general. So can you walk us through what was the impetus for writing that blog post? What was kind of the TLDR, and why did you decide to write that post?
It was quite clear that central bankers were beginning to freak out a little bit about some of the inflation data that we were seeing. And the question from investors for the past 6 months was always when are they going to blink? When is this going to be too much pain? When is the kind of central bank put going to come back and they'll ease policy and we'll be back to that kind of everything rallying again. And I think that investors just, misunderstood the thing that central bankers were really worried about. It wasn't that they were concerned about recession right now. It was more they had this kind of nightmare scenario of what happened in the 1970s. And I think you have to think about inflation from a central banker's perspective, which is not something investors are used to doing. If they tighten too much and cause a recession, then that's kind of embarrassing, but recessions happen to some of the best central bankers in history. And in fact, we celebrate some central bankers for actually causing recessions. So you remember Paul Volcker and, breaking the back of inflation. And he's kind of celebrated as this figure that was prepared to get tough in order to force inflation down. But if instead they fail to get a grip on inflation, and it turns into this kind of wage price spiral dynamic that we had in the 1970s, then these central bankers are going to go down in history as a sort of textbook example of a monetary policy failure. We'll still be talking about these central bankers in 30, 40 years' time. And so from a personal perspective, the incentives of central bankers have been very different to those of investors. They are prepared to generate an enormous amount of pain to prevent something that they see, much nastier that might be further down the line. And they don't want to go down in history as these complete jokers. So you have, Jerome Powell kind of channeling Paul Volcker and telling us how fantastic he was. You have the ECB, reminding us of how great the Bundesbank was, and desperately doesn't want to go down in history as the kind of Bank of Italy that caused these disastrous policy errors. So the point of that blog was really that you have to put yourself in the shoes of these central bankers, and they're not going to blink. As long as there's any chance of this turning into this kind of 1970s dynamic where inflation just spirals out of control, then they're always going to lean against that. And if that means a recession now rather than a much deeper recession in 2 or 3 years' time, then they take that. And so that's a very different world to the one that investors have been used to, because we've been used to a world where inflation is always threatening to break too low. So any trouble in the financial sector, any trouble in the global economy, they immediately cut interest rates to try and prevent their economy from turning into some kind of Japanese deflationary dynamic. But we're just in a different world now. We're in a world where the prevailing bias of monetary policy has just totally changed. And this is a very different kind of dynamic that investors are going to have to get used to, because I think this is going to be sticking around.
The guest on our show last week was Mike Howell, and he had this phrase, there are no doves in central bank heaven, right? And I think given the choice, right, between defining a legacy, if you want a Burns or a Powell, or a Burns and a Volcker, I think we definitely want to go down or Powell definitely sees himself and wants to channel that Volcker energy. I've heard you bring up this comparison to the 1970s multiple times. Do you see that kind of stop-start dynamic repeating itself in the current way of thinking, or what parallels do you feel like are appropriate to draw from the 1970s to the current period?
Yeah, I mean, I should be clear. I don't think this is the 1970s. I think about the 1970s as basically a power struggle. So we had this kind of post-World War II economy, this mixed economy. You had very powerful trade unions, very powerful labor versus capital. And so we then had this productivity slowdown that started from the kind of late 1960s onwards. And the 1970s was basically a power struggle about who should bear the costs of that productivity slowdown. And so then you had these sort of commodity price shocks, these big commodity price shocks, and then you had this pressure on real incomes that came from that, and you basically had this conflict about who should kind of bear that burden. I think we basically spent the last 40 years dismantling that economy. So, since the kind of late 1970s, we've been living in this kind of neoliberalism regime, which has basically just meant that we spent 40 years destroying worker power. So we destroyed the trade unions, we opened up global capital markets, we opened up our economies to the rest of the world. We allowed, rapid immigration. We had this big increase in the labor force. So we basically destroyed worker power. And so what you see now is that when you get these big commodity price shocks, workers just get hit by this. And we're seeing this right now with this kind of big squeeze on real incomes that's happening, particularly in Europe, but also in the US, where wages are just not keeping pace with the inflation that we're getting. So what you have is a very different type of dynamic. Instead of that sort of spiraling dynamic that we had in the 1970s, we just have this big squeeze. And so, I think, as you said, the better historical analogy is actually with the 1940s, because if you look at what actually happened in the 1940s, you came out of World War II. You had this massive supply side disruptions because we basically destroyed, the global shipping industry. We had massive shortages of commodities. We had huge numbers of soldiers that we needed to reintegrate into the labor force. So you had this big mismatch in labor markets. You had massive pent up demand because we'd had rationing for, about 5 years of rationing. And so you had this mixture of, very aggressive pent-up demand and very serious supply-side disruptions. And it gave you this big surge in inflation. So US prices after World War II basically increased 20%. In the UK, we had an increase of 40%, so a massive increase in the price level. But what you didn't get is that conflict between labor and capital. So you didn't get the spiraling effect. You just had a one-off increase in the price level. And I think basically that's what we're looking at right now. The kind of the kind of feed through from the last 2 years of pandemic and war has been this big shift up in the price level. But I think inflation then settles down. I don't think it goes back to 2% or below 2%, but I don't think we're going to be looking at inflation numbers anywhere near what we've been seeing, over the last 18 months. And certainly I don't think we're going to get that kind of spiraling dynamic that we had in the 1970s.
Post the 1970s sort of inflationary regime, we also had kind of that combination of Reagan and Thatcher, right? And that was an enormous shift in the direction of favoring capital, both from just like tax laws, but also deregulation. And that's, part of the reason probably in addition to lowering, that constant step ladder down of interest rates, why equities, especially US-based equities, have done so well. I guess two-part question for you is, I'll just start with, what are the primary consequences of that regime potentially being at its end and a shift from a focus on capital and capital appreciation back to labor?
So I think it changes everything. And that's the kind of essence of the macro supercycle that I talk about in my research. So I think you can trace these kind of long 40, 50-year super cycles in the macroeconomy. And they're basically about the balance of power between labor and capital. So before the two world wars, capital was totally dominant. We had, rapid globalization. We had massive technological change because of the Industrial Revolution. So you had very low inflation, disinflation. You had big increase in the profit share, big decline in the wage share, growing polarization, growing inequality. An economy that looked a lot like the economy that we've had over the past 10 years after the global financial crisis. And then after the two world wars, you had these big political shifts. You rebalanced the balance of power between labor and capital back towards labor. So you had the first socialist parties, you had the beginning of the welfare state, you had the first populist policies, we had a bit of de-globalization after the two world wars. You just radically transformed the economy. The first trade unions emerged, the first socialist parties. And we came out of the Second World War with a very different type of economy, with a balance of power that was very firmly tilted towards labor. And for a long time, that seemed to work until you hit the 1970s and you get those wage price spirals and, the power of labor almost goes too far. So then Thatcher, Reagan come in and they just dismantle that economy, and they get help from central bankers. So you have, the Bank of England and, Paul Volcker raising interest rates very aggressively, which enabled this kind of the beginning of this neoliberal supercycle, because those politicians could then just completely destroy and decapitate the trade unions. So then, as you say, you then had this kind of 30, 40-year cycle that kind of ended after the global financial crisis, when it hit an extreme. So we had zero interest rates, we had austerity everywhere, we had kind of endless QE. And the result of that was this really bizarre policy mix, because we had monetary policy that was very, very expansionary, but completely ineffective. QE did nothing to stimulate the economy. And you had fiscal policy that was much too tight and very effective. So austerity, caused this kind of gut-wrenching, destruction of the economy, particularly in Europe, where it was most extreme. And, the result of that was that you had zero interest rates, and you had this constant re-rating of all asset prices. And you had a constant re-rating of sort of long duration tech stocks in particular. Now, I think that world has changed. I think we emerge from this with a very different type of balance of power between labor and capital. We already have very severe labor shortages. I think those are going to get worse over the next decade because of population aging, but also because of de-globalization. The legacy of the last 2 years is going to be de-globalization. We're going to be shrinking supply chains. We're going to be reducing immigration. There's going to be this kind of realignment of political powers globally towards these regional trading blocks, rather than this kind of hyper globalization that we had over the past 30, 40 years. So we start to tilt the balance of power back towards labor for the first time in 40 years. And that means that the kind of secular environment for inflation and interest rates is beginning to change. I think that the economy that we've had over the last 12 months probably exaggerates all of that. We're not going to have 8, 9, 10% inflation rates, but we're not going to have inflation going back to sub 2%. So I think the basic task of monetary policy is changing. From a world where inflation always threatened to fall too low, was always threatening to fall below 2%, we're going to be in a world where inflation is always threatening to rise above 3%. And that means we're not going back to QE, we're not going back to zero interest rates, and it changes the whole focus of what investors have to do. Because for the last decade, all you needed to do as an investor is buy long duration US tech stocks and watch them get re-rated. You didn't need to be any sort of financial genius to invest in those companies and enjoy massive returns. And now we're in a world where actually you need to think a bit more about the sort of environment that's emerging from this. What are the growth opportunities in this new world? And how do you get exposure to those? So it's about picking value stocks. It's about picking exposure to the real economy. It's about commodities. Commodity rationing and shortages is a sort of natural outcome of this new world. And so, the basic task of asset allocation is just radically changing, and it's not going back to how it was before.
Let's talk a little bit about the labor market in general, and let's move into like a threat of recession here, because I think that's the other. I've heard you speak about this as well, and actually there are many indicators. If we're not in recessionary territory yet, it looks like things are headed that way. At least some of the forward-looking indicators like ISM and PMI and all that kind of stuff. But one thing that's been persistently hot is the labor market, right? And you haven't seen that second mandate of the Fed, which we know they pay a lot of attention to, unemployment really budge, despite earnings, kind of finally start to revert in a pretty significant way, at least forward expectations of earnings in general. Walk us through what why do you think the labor market remains as tight as it is? And is that a facet of or a direct result of this kind of shift, this broader shift that you're talking about capital to labor?
So I think the key point is that this isn't a recession. We spent the last kind of 3-4 months debating this recession, but I think this is a sort of fake recession, because this is a fake business cycle. Nothing. For the last 2 years, I've had investors saying, "Where are we in the cycle?" well, this isn't a cycle. Nothing about this is a normal economic cycle. We shut down the economy and we reopen the economy, and we're struggling to come to terms with what the new world looks like. And there's been all these kind of legacies from the last 2 years that are still, and these big distortions that are still trying to unwind. So I think we have a big problem in the manufacturing sector. And because economists tend to build leading indicators for the economy based on manufacturing activity, all of these leading indicators are plunging. But this was entirely predictable. We have consumers switching from goods to services, which they were always going to do as we came out of the pandemic, just at the point where all of these retailers and wholesalers have been building up these massive inventories. So we have this kind of bullwhip effect in global supply chains, which has just been in a state of flux over the past 2 years. That's beginning to turn the other way. So you have this massive kind of disinflation that's coming from global goods.
Can I just get you to double click on exactly what that bullwhip effect? I know you were just starting to get into it there, but Michael Burry has been very public in kind of sharing this idea of the bullwhip effect. Can you just elaborate for the listeners what exactly that is?
Yeah, so it's basically kind of logistical chaos that we haven't had for a very long time. We used to have recessions all the time that were caused by global supply chains, global inventories, because it was very hard for producers to figure out where demand was headed. 30, 40 years ago, you just didn't have the kind of just-in-time supply logistics that we've been used to. And you didn't have the kind of computerization of supply chains. So you had these big inventory swings. Now, over the past 2 years, because of the pandemic, because of the lockdowns, because of all the supply chaos, you've just had these massive inefficiencies in global supply chains. And for a long period, when consumers all over the world were basically sitting at home in lockdown, ordering stuff off the internet, you had this huge demand for goods, which these companies couldn't meet. And then they began to build up, inventories of goods in order to meet demand, just at the point where that demand had evaporated, because we were then rotating back into services because we were coming out of the pandemic. So you had, a situation where global supply chains seemed to be massively overheating, to suddenly a situation where you've got massive disinflation coming from global supply chains. So that's the kind of bullwhip effect. It's this exaggeration of demand moves across the supply chain, which then cause these big distortions in the economy. And so, we had an economy that appeared to be massively overheating because of those supply chains. We're now flipping the other way. This is a sort of fake recession signal. This isn't a genuine recession signal. This is a shift in the way people are choosing to spend their money. We're now trying to book 3 holidays rather than, buying home gym equipment off the internet. So that's the bullwhip effect. And it should have been entirely predictable. But, we can see very clearly from US retailers over the past 3 months where they've been building up these inventories of stuff that they can no longer sell, because, people aren't spending money the same way that they were spending money 12 months ago when they started to build up those inventories. So you get disinflation in goods that comes from this, but it's not this isn't a genuine recession signal. This is something that everyone should have seen coming. And actually, at the start of the year, I was writing research saying we're going to get a summer recession scare that comes exactly from this dynamic. I'm just amazed that it's here and people are so freaked out by it. But in terms of the labor market, I think you're right to focus on the labor market, because you can't really define a recession without looking at the labor market, because for the US, I think recessions are defined by the labor market. When employment starts to go down, when unemployment starts to go up, that is the dynamic that sets off a true recession. And the reason for that is that when people start to lose their jobs, you then get these second round effects. So people lose their jobs, they stop spending. People fear losing their jobs, they stop spending. That feeds back into corporate revenues. Revenues go down, so you get further rounds of redundancies, and the whole thing feeds on itself. That is the classic recession dynamic. We are a long way from that right now. And, today we had another big payroll number after last month's payroll number, clearly confirmed that we're not seeing that sort of dynamic. And in fact, what we're seeing is very acute shortages of labor. And so, even if demand is turning down, there is this big incentive for companies to actually hang on to their workers rather than let them go. Because if the demand recovers quickly, these companies are not going to be able to replace those workers quickly. So I just don't see that recession dynamic kicking in. There is a recession risk, That recession risk is coming from central banks over tightening, but we're not there yet. We haven't got to the point where central banks are over tightening. So we shouldn't expect the labor market to start cracking.
I guess that's my next question to you is then, do you see moderating inflation? I mean, I guess the last month's CPI print, we finally saw, if not in the relaxation that we wanted to see, we at least went from above a 9 handle to 8.5 or whatever it came at. So do you think that trend is going to continue, or are there other pressures that, I guess what's your short to midterm view on inflation and whether or not we've rounded the corner?
I think it's definitely moderating. So I think that, I think the peak inflation story is probably right. I think we're a little bit vulnerable to what happens with Putin. If Putin turns off European gas supplies in the autumn, we're going to get another stagflationary shock to the global economy, which is not going to help that inflation narrative. But, if we don't get that, I think there are good reasons to think inflation will slow over the next 3 to 6 months. We have food prices globally coming off. We have commodity prices coming off. We have a lot of disinflation coming from global manufacturing because of this bullwhip effect in inventory and supply chains. So I think there's good reasons to think inflation will come off. I think a big part of the inflation we've had is transitory and was always transitory, even if nobody wants to admit that anymore. So I think that part of inflation comes off pretty rapidly. The question, I think, is where inflation is ultimately going to settle. And are central banks prepared to tolerate slightly higher inflation than they were in the past? So my guess is that we're not going to go all the way down to 2% or sub 2%. I think that we'll probably linger above 3%, possibly as high as 3.5%. I know that central banks say they don't want to accept an inflation rate of 3.5%, 3%. But I hope and I think that they're bluffing. I think that if inflation settles at 3.5%, and it turns out that this is not the 1970s, we're not getting double-digit runaway inflation, I think central banks would bite your hand off if you offered them that right now. I don't think they'll admit that. None of these central banks are ever going to tell us that they've raised their inflation target. But the way I think about this is that they're going to have a kind of revealed preference for higher inflation. And what I mean by that is that if inflation goes to 3.5% and it stays there, they're not going to keep hiking aggressively in order to force it down that extra 150 basis points. So I think, they will tolerate a higher level of inflation than in the past. And I think that is really the sort of key to a soft landing coming out of this. There has to be some tolerance for higher inflation. If they are absolutely insistent that inflation has to go to 2%, then they're just going to keep hiking, because I just don't see that sort of dynamic is where we're headed.
So, I maybe to return again to the interview that you gave with Alfonso and Andreas, your sort of advice at that period of time, which was May of this year, which was June, July, August, 4 months ago, right? You said for the next 3 to 6 months, be bearish, or at least be more cautious, right? If not, sit on your hands, do something like that. But maybe towards the end of the year, right, you start to see things turn around, and that's when you move back into longer duration type assets, bonds, tech stocks, et cetera. I'd love to know, now that we're 4 months later and kind of into the teeth of what I think you called pretty accurately, has your view changed at all? Like if I asked you right now to kind of put your timeline on when we sort of start to see this pivot, right, of rounding the corner of inflation successfully, the world starting to get a little bit more optimistic and understand that we aren't in a real recession here. What's your kind of timeline on all of that now?
I think this is still quite messy, to be honest. I think that we still have these sort of big lingering distortions from the pandemic. I think we still have part of this growth scare to play out. So, the thing that made me negative back when I spoke to Alf was that, I was kind of anticipating this summer recession scare. And I think that's clearly started, but I think it probably has further to play out. I think that we're still going to get some further deterioration in leading indicators. The manufacturing sector looks horrible. I think we've got a very serious stagflationary shock in Europe. Europe, as bad as the US economy seems right now to some people, it is nowhere near as bad as what's happening in Europe right now. We basically have inflation headed to 10% and wages growing at 1%. So people are getting seriously squeezed by this inflation. So I think that the sort of 3-4 month outlook is still fuzzy and confusing and messy. And it's still vulnerable to what happens with Ukraine and Putin and the energy situation. But I think if you're looking at the sort of beginning of next year, I think inflation will be much lower. I think that we'll see clearer signs that the labor market has cooled down in the US. So I think wage growth will have slowed. I think job openings will have slowed. And I think that will make the Fed far more relaxed than it's been over the last few months. I don't think they can pivot in the way that people are expecting. So I don't see that sort of environment where the Fed is quickly cutting interest rates. I think right now financial markets are basically priced for perfection. You have this sort of perfect 1995 style soft landing and Fed pivot. And this just looks very different to 1995. We just don't have that sort of the same sort of dynamic as we certainly don't have the sort of Goldilocks economy that Greenspan had in the mid 90s that allowed him to engineer that pivot. So I think the Fed will keep policy quite tight. I don't see them easing, but I think that they can start to slow down the pace of policy tightening. Instead of 75 basis points a month, maybe we get 75 basis points a year. And that, I think that's going to start to alleviate some of the pain that we've been getting in risk assets. I'm not sure that I would be plowing into long duration tech stocks again. I wouldn't be big buyers of the FAANGs at this point. But I think, as I said, in the kind of super cycle, you start to think, well, where are the growth stories that emerge from all of this chaos of the last 2 years? And I think there are growth stories, and there are sectors of the stock market that will benefit from that. And those are the places where I think investors will be putting their money. And if the outlook for those sectors, I think, is pretty good over the next few years.
So maybe we could double click on one industry that you just outlined there, which is energy, right? Which has really reemerged as an extremely important story in let's say all financial markets. And it was a sector, especially in the US, that's gotten beaten down by, among other things, kind of the ESG mandate, right? That's been getting broadly passed through central banks and higher levels of finance writ large. I'd love to get your thoughts on the energy sector in general, kind of moving forward. But also, I know you've got a seat over in Europe, right, and can maybe speak with a little bit more boots on the ground than some of the commentators that we hear from so often over here. So I'd love to actually get your perspective on the European energy situation. Is it as dire straits as it seems over here? I think by now we've all kind of seen the meme stock charts of German electricity prices, natural gas prices, et cetera. Do you see that as being a persistent pressure? Is it a spike? Should people be kind of worried about that as a black swan event? Not only for European energy markets, but almost like a geopolitical risk, for the world if Europe actually goes through as dire straits as it looks like. Maybe let's start there with that question.
Yeah, so I mean, there's plenty of pessimism about the US economy right now. I can tell you that the European situation looks infinitely worse. We have the same levels of inflation, higher inflation perhaps in some countries. UK inflation is about to head to 13%, which is just something we haven't seen in a generation.
Yep. And
we don't have the wage gains. So this is a massive squeeze on people's real incomes. And, in the UK, our energy prices are set to double during the autumn because we have these price caps that are expiring. Same situation across much of Europe. There's a massive surge in, people's energy bills. And, wages are just not keeping up with this. This is why it's just nothing like the 1970s. We just don't have the sort of bargaining power or the labor power in order to demand offsetting wage increases. So we're just getting massively squeezed by this. And I guess the risk is that as we go into the autumn and people start to use energy more intensively, Putin is going to turn the screws on this and, cut the energy supplies even more. And, that's going to cause more pain. And so, this is a very serious stagflationary shock for Europe. Our incomes are being squeezed and we're going to have to cut spending on everything else in order to pay for these energy bills. And so what we desperately need is some sort of government support mechanism in order to, keep people afloat. Because if they don't, we're going to have, very serious increases in poverty during the winter. Some people are just not going to be able to afford to live. So, as bad as the kind of inflation is in the US, to me, it doesn't feel like the US is suffering a kind of cost of living crisis in the same way that Europe is suffering this. So this is a very nasty and extreme situation, and it could get materially worse. So, I think this is, I'm pretty pessimistic about this. And, we're sort of at the mercy of Putin at this point, because, The plan clearly is to transition away from Russian natural gas, but we can't make that transition quickly. So, we have this winter to get through, and that's the big problem that Europe is facing.
What is the dynamic internally, right? I mean, there's always been this kind of, or let's say for the last 50 or so years, right, ever since the EU monetary union, of this division in between North and South Europe, right? Where, not to offend anyone here, I'm Italian myself, but there's kind of, you have the pigs in the South, right? And then, kind of the supporting, let's say, mainstay economies, right, of Germany and the UK. The UK is now departed the European Union. We're not really sure what those trade deals are ultimately going to look like, or what the economic relationship is going to be, and whether the UK is going to tether itself economically more to the EU or more to the US. Germany, which is kind of usually the shining star, is actually suffering the most, right? Because as it turns out, they were the most dependent from an energy perspective on Russia, and now there are these kind of geopolitical strains. So even internally, I mean, what might Americans, let's say if you're sitting in an American seat like I am, what might you not be understanding about some of those internal dynamics, even in between the countries in the European Union?
I think the really important thing here is that we have an ECB that is determined to ensure that that these kind of dynamics don't blow up into another kind of sort of self-fulfilling euro crisis. So if you go back to, so this is a very different dynamic to what we had during the sovereign debt crisis, after the global financial crisis. Back then, there was just, you could see these kind of massive problems in the periphery, and it wasn't clear that anyone was going to come in and help those countries. So you almost had a one-way bet against the euro. So you had, particularly kind of hedge funds in the US and the UK, they could see this dynamic, and they could see this almost one-way bet against Europe, because if they bet against sort of Italian debt, Italian yields would rise. That would lead to more austerity in Italy. That would increase the risks of Italy leaving the euro, and you had this sort of self-fulfilling market crisis. I think that we don't have those dynamics anymore, because we have an ECB that has struggled a bit to understand its role in this, and has made the odd kind of mishap over the last couple of years. But it is clearly committed to ensuring that sort of self-fulfilling market crisis doesn't happen again. So in terms of this turning into a sort of market event, I don't think that's going to happen. I think the ECB understands that they have to prevent that from happening in a way that they didn't understand after the global financial crisis. But clearly, from a political perspective, this is very challenging. But I don't get the sense that this has led to sort of disunion in Europe. In fact, I think it's actually pushed these countries closer together. And certainly, the approach to Russia and the Ukraine situation has been, remarkably harmonious, actually, in terms of European politics. European politicians have kind of stood together against Putin in this dynamic. But obviously, that's going to get tested over the winter. If this situation gets materially worse, we are going to see some of these countries saying, well, why are we doing this to ourselves? Is it worth it? I think that's a sort of natural dynamic.
That's where kind of the Maslow's hierarchy of needs sort of kicks in, right? And definitely access to warmth and shelter and food is probably at the top of that list, I would say. Maybe we can kind of conclude here. I've got two kind of more overarching questions. One is just the role of central banking moving forward, especially in this new kind of secular environment that you outlined. And then I'd love to get your perspective on, outside of kind of some of the sectors that you outlined, defense, housing, et cetera, energy, et cetera, like what your advice to investors are. I've heard you, I know you've kind of spoken about the idea that central banks already, right, are not as important as people tend to think they are. It's even funny for me because the whole time I've been alive, right, all I've heard is don't fight the Fed. They have an enormous amount of power over financial markets, and it certainly seems like they're sitting in the driver's seat. But I listened to some of these, people who were operating in financial markets 30, 40 years ago, and no one really listened to the Fed quite as much, right? Or it didn't seem like they had that direct iron grip on markets like they do. So I guess my question to you is, if we move towards this environment of greater emphasis on labor, more secularly high interest rates, do you see the role of central banks changing in markets from what they are today?
Well, I think the role is changing. So I think that we were used to these sort of these kind of guardians of financial stability that as soon as something went wrong in financial markets, they would immediately step in, they would immediately cut interest rates, they would immediately throw QE. And in a sense, the sort of incentives of investors and central bankers were perfectly aligned because, in a kind of low inflation environment, any shock to the economy has the potential to cause a recession. And so any shock to the financial sector has the potential to cause a recession and to cause disinflation. And so, it was a sort of benign, co-interest that we had. I think that's changing, and clearly that's been the lesson of the last 6 months. When I've had investors all the time saying, "Oh my God, when is their pain? When do we hit their pain threshold? When are they going to come in and rescue us?" Clearly they haven't given a damn about investors' P&L through most of this year, and in fact they've actually wanted to squeeze the financial sector in a way that we just haven't seen in a generation. So that's changed. I think you're right to question their power. And I think that, for the last 30 or 40 years, they've been telling us that they were the ones that gave us low inflation. So, they basically believe their own bullshit on this, as far as I can see. You had central bankers that took credit for the sort of great moderation in inflation. They believed it was their credibility that had anchored inflation expectations at very low levels, all this nonsense that central bankers come up with. And now we're sort of on the reverse of that because, as inflation has gone up, as inflation expectations have started to rise, we're seeing the flip side, which is where people are blaming central bankers for the inflation, which probably they didn't really cause. But they can't say that because having taken credit for the low inflation, they now have to take responsibility for the fact that inflation is going up. So the question is going to be, if we get to the point where inflation becomes a persistent problem, and central banks are trying to do something about it, but can't do something about it, is somebody going to come in and say, well, you guys have had your time and it's over now? And so are we going to see politicians actually trying to tell central bankers, the good times are over and you guys need a different mandate, or, we're going to have to take that away from you? Is there an environment in which these central bankers begin to lose their independence? I wouldn't rule that out. Because we've been used to this world, which I don't think exists anymore. And the views on central banking independence can change very rapidly. One of my first jobs was at the UK Treasury. I joined the UK Treasury in 1997. It was the year that the Bank of England was given its independence by Gordon Brown. And actually, the Treasury had written this paper just 12 months earlier that argued that the Bank of England should not be given its independence, that there was no reason to give the Bank of England independence, that the government could do just as well. But a new politician came in and he basically said, I don't care what you guys think. I'm making the Bank of England independent. I'm doing it on Monday. And the Treasury had 4 days to figure out how to do that. So, views on things like this can change pretty quickly. That changed in the course of a year and over the course of 4 days. I wouldn't be surprised. These central banks, that they're sort of the way I think you can think about this in terms of the sort of neoliberal supercycle. So we've been in this neoliberal supercycle for 30 years. Central banks are almost the ultimate protectors of this neoliberal supercycle. And they're now telling us if they have to cause a recession in order to protect neoliberalism, in order to ensure there is no secular change in the economy, they will do that. But at some point, they clearly don't have a mandate for causing mass unemployment. So at some point, if they really go down this route, I think the politicians are going to come in and say, well, you guys have had your time and it's time to try something a bit different. So I wouldn't rule that out.
4 whole days to prepare, huh? Really, whoever that politician was, he really believed in giving people enough time to prepare for just a small change like that.
I have the paper. I kept a copy of it. It was written 12 months earlier, and it concluded with the words, central bank independence is not worth all the upheaval that it would entail. And then Gordon Brown comes in and he says, yeah, I've seen that paper, but I don't care what you guys think. This is going to happen, and you guys have got 4 days to figure out how it's going to happen. Make it happen. Things can change.
Okay, well, 2-part question, which I love to do. When you were sitting in your seat then in the Treasury as a newbie, What did you think? Did you think Gordon Brown was making the right decision? And now you, Dario, with some battle scars in between now and then, do you think that was the right decision in retrospect?
I think independent central banking is fine. I don't have a problem with central banks who believe their own bullshit as they have done over the last 20 years. I think the issue for the past decade in particular has just been this horrendous policy mix. We had very tight fiscal policy at a time when fiscal policy was super effective, and we had very easy monetary policy at a time when monetary policy was totally ineffective. And it was that policy mix that gave us, bond yields at 800-year lows. I use UK data. We have this data going back centuries. I can tell you that, UK bond yields are at their lowest level in 800 years as a result of this disastrous policy mix. So actually, I don't have a problem with an independent central bank, a central bank that wants to raise interest rates. What I have a problem with is the policy mix overall. And a big part of that has got to be about fiscal policy. And, a big part of this sort of new super cycle is that we have to have politicians that are more willing to use fiscal policy in order to get the economy going again. Because the problems that we've had over the last decade, inequality, polarization, crumbling infrastructure, climate change, these are not problems that we can solve with monetary policy. Cutting interest rates to zero and doing QE is not going to solve the basic macroeconomic problem that we've had over the past decade. So I used to joke, about MMT. I didn't have a problem with politicians believing in MMT. In fact, I think we want to live in a world where politicians do believe in MMT. But if we have that in combination with independent central banks who don't believe in MMT, I think you end up with a much more, growth-friendly policy mix than what we've had over the last decade. And it was that austerity that proved to be so dangerous. I just don't think there's a way back to that austerity now. And I think that's the bit that if central banks try to fight, that's where they're going to run into problems.
All right, let's end with let's say you're sitting in an investment seat or an allocator seat, because one other facet, let's say over the course of the last 20 or so years, and maybe this is a direct goal of central banks or an indirect one, whatever it is, we've seen kind of a pronounced decrease in volatility, right? Things have been a pretty steady rise up. And it's, over the last couple of years, definitely there's the exogenous event of COVID and everything, but we're starting to see increased levels of volatility. It's happening in financial markets. I would argue it's happening in society in a more broad way. But should investors be preparing for a decade of increased volatility? And if so, let's say, I know you have a tilt maybe more towards value stocks in certain sectors, but how should investors be playing this or thinking about allocation that's different now in this new secular environment versus the one that we've had over the course of the last 20 years?
Okay, so I think if you think about the great moderation, which is kind of defined macro for the last 30 years, very low inflation, super efficient supply chains, globalization, those are the things that are beginning to change. I think inflation is going to be much more volatile than we've been used to. I don't think it's going to be, massively higher. I don't think we're going to have 5, 6, 7, 8% inflation, but we're going to have much more volatility inflation than we've been used to. And a big part of that is climate change. So you're going to have kind of direct physical consequences of climate change. And, we've experienced that over the past 2 years, more extreme weather. In the UK, we've had, the highest temperatures that we've ever recorded. And, it's led to all kinds of problems in the UK economy over the past 6 months. So you're going to get more extreme weather. That's going to lead to more extreme swings in commodity prices. But also we're going to be transitioning to new, greener technologies, newer energies. And those are intermittent in their very nature. So that in itself is going to cause a lot of volatility in inflation. So we're going to have much more volatile inflation. Every time inflation goes up, our real incomes will get squeezed. So you're going to have more volatility in the real economy that comes from inflation. That's not something that we've had to deal with in a very long time, but it's something that we clearly have right now. It's one of the big reasons that you have a growth scare in the US is just the fact that wages haven't kept up with prices. So people are being squeezed. So you get more volatility in inflation, more volatility in the real economy that comes from that. And so I think, this is a world where overall, I think returns on bonds, particularly real returns on bonds, are going to be horrendous. That was the 1970s, but it was also the 1940s and 1950s. Over long periods of time, even if you get transitory spikes in inflation, it's just going to destroy real returns in bonds. I think equity returns are going to be more volatile than we've been used to. But I think the big story is this rotation away from kind of zero interest rate, perma QE growth stocks towards those sectors of the economy that actually benefit from this environment. So I think, commodities, particularly because of climate change, we're going to need massive public and private investment in green technologies. There's going to be investment opportunities in that. I think that there's a secular housing story. Again, near term, very messy, interest rates going up, bullwhip effect in housing. There's another bullwhip effect that we've seen on the kind of inventory side in housing. That's going to be quite messy, but there's a secular story coming out of that, because in the US, we have this kind of bulge in the population of people moving into their 30s, which is prime home buying age. So there's a secular story there. There's a secular story in housing that comes from hybrid working. Because we're only going into the office 3-4 times a week, we're now prepared to live further distances away from the office. And so you're kind of bringing in a new first-time buyer, people that were previously kind of priced out of prime property locations. They can now afford to buy houses. So there's a secular story in housing. There's a secular story in public investment, because we're going to have to invest in infrastructure. One of the big things about austerity was that we massively cut back on public infrastructure over the past 15 years. That can't continue. That has to reverse. We're going to see, a bigger role of the government in the economy. So, as we said, defense spending, sort of trying to take control of key commodities. So things like semiconductors, but also, just actual commodities. I think all of that has implications for investors. I think that bonds will still have that role as a sort of equity hedge, but it's not going to be as clean as it was. So that the kind of correlation between bonds and equities that was constantly negative, after the 2000s, that's going to become weaker. So that the hedge from bonds is not going to be as clean as it was before. But I think, the big story is about investing in commodities, investing in value stocks, investing in tangibles, investing in the real economy. That sort of realignment of the real economy and financial markets is absolutely critical in all of this.
Dario, unfortunately, this is all the time we have. Lots of stuff to chew over here for sure. If folks want to find out more about you, your research, what is the best way to do that?
Probably the best place is Twitter. So if you follow me on Twitter, it's just at Dario Perkins, one word. Then I use Twitter quite a lot. I have a blog that I write that links back to some of my other research. So that's the best place to start.
Awesome. Well, thank you so much for coming on the show. We'll have to do it again soon.
No worries. Thanks for having me.